Well, that sounds kind of ugly, huh? But but due to the banking crisis and everything, things kind of got gloomy there. But the best person to talk about this is uh, Olivier, right? Am I saying it
That's
right?
right. Yep.
Olivier Manuel,
Olivier, you got
and
it.
from Digital Assets Insight. So, welcome. I'm glad you made it here, and we appreciate your time. So I'm going to hand the mic over to you.
Awesome. It's a pleasure to be here. Future of food was definitely an important topic. So that was very, very interesting. And now I hope I won't be too much of a downer. I think I want to be balanced in the treatment of this topic. I'm going to present. I'm going to share my screen so I can present, and then we will get into it. All right. So is everyone able to see the presentation?
Yes, we can see it.
Wonderful. All right. Well, it's a real pleasure to be with everyone here today. My name is Olivier Manuel. I'm known for my work on disruptive innovation and products like the smart TV, which I think many of you may have in your living rooms, but my roots are actually in real estate. I started my career as an analyst on the mortgage desk at Goldman Sachs and spent my time developing computer programs to evaluate large pools of real-world assets. And my talk today goes back to those roots. I'm going to talk about a disruption that's going on in the real estate market and a disruption that combines traditional finance, markets, and technology. So, I always like to start by defining terms. So what is liquidity? Well, real estate liquidity is the ease of converting properties into cash without losing value, without losing too much value. And secondly, the ability to get financing for those assets. And I was with you guys at EXP here last December. Actually, we were in the metaverse, so times have changed a little bit. Now we're in Zoom. But I was in the metaverse with probably many of you here now and spoke about what was then growing liquidity challenges in commercial real estate. And unfortunately, many of the warnings that I gave then, many of the subjects that we discussed, they've come true. And that's why Jim asked me to come back and give you guys an update on where we are in this crisis. So I want to start by doing a little recap of that December talk very quickly, and then get into the update from there. So as you guys know, it's a challenging but very mixed environment in commercial real estate. Office, especially B and C class, is very challenging. A class is doing a lot better. People seem to be trading up to higher quality but smaller spaces. But the B and C class office is very challenging. And at the end of last year, office vacancy rates went to a record high of over 18%. And in markets like Manhattan, where I'm based, or in Silicon Valley, you're over 20%. So, multifamily has been a bright spot, but, you do see concerns over slowing rent growth. In an inflationary environment, you can't always raise rents fast enough to follow the market. And the reason I want to go through this is just to say, I'm going to paint a big picture looking at the US as a whole, but there's a lot of important variation by subsection and geography in this market. But what's true is that across the board, you're seeing a drop in mortgage financing. And that is creating liquidity problems. There's money that's coming out of the system, and that's creating liquidity problems for the owners of commercial properties. And what I pointed out last December is that an especially vulnerable area is loans that are maturing. So that represents a big refinancing challenge and billions in property, and we will talk more about that. Here, this slide is talking about CMBS loans, which are loans that are obviously pooled together. and sold in the secondary market. And so those loans are some of the least flexible loans. And that creates problems when a property owner who has taken one of those loans needs to refinance. They're not going to get a lot of flexibility, and it creates a risk of default. So we'll get more into that now. So what I want to go over with you guys is essentially three parts. So first, the roots of the crisis. So talk about the mechanics of what it is, what's causing it, and how we got here. And then I want to talk about where we are now. And then third and finally, the threats, and perhaps more importantly, for all of you, the opportunities. So let's get into it. Big picture, the issue is debt. We all know there's a lot of debt out there, especially in commercial real estate. You're talking about in the US, a $4.1 trillion market of professionally managed properties. And if you look at all the commercial banks together, there's 2.9 trillion of loans. And I also want to call to your attention the growth here. So if you look, over the last 10 years, there has been a significant growth here in the amount of loans. And we're seeing the effects of that now. So really, debt is at the core of this liquidity crisis. And I think we all know that inflation is the trigger, is what started this. But I think it's useful to look a little closely at the chart, at the exact data, and my favorite indicator is the price deflator. It's the most accurate, reliable measure of inflation. And what you see when we look at this is, of course, we've had 2 decades of well-controlled inflation, but then a large increase starting in 2020, and really consistently going up until very recently. And this is obviously very problematic. And when we go and dig one layer deeper, what happened? Well, inflation started to go up in 2020, but we see that the Fed delayed. They didn't act. You see here, they waited to raise rates. And in April 2021, Jerome Powell, the chair of the Fed, was calling inflation transitory. And he said, quote, "We want inflation to run up a little bit higher than it's been averaging in the last quarter century." So it's not very often you hear a Fed chair saying they want higher inflation. And the markets, unfortunately, listened to him, and inflation went up a lot. And it actually took the entire year more. So it wasn't until March of last year that the Fed started rapidly increasing rates to fight inflation. And that increase, which you see here, has been one of the fastest rate rises in history. The Fed funds rates went from almost 0 here to mid-4s. And because all interest rates are based off of the Fed funds rate, what that means is that all interest rates went up, and that sucked liquidity out of the system very quickly. And then something happened, which a couple of you may remember. There was a crypto crisis. Now, why am I talking about a crypto crisis? And it's not just because I cover digital assets. It's because, as you see here, that was kind of the butterfly that flapped its wings. I don't know if you're followers of chaos theory, but there's this classic example about how a butterfly could flap its wings in one place, and that could create a storm miles and miles away because of the effects of chaos theory and the way little things can grow. So in a way, the crypto crisis was those butterfly wings. And the first domino to fall, uh, which resulted partially from this reduction in liquidity, was the collapse of what's called a stablecoin called Terra USD. And I don't think it's good to defend those guys. I think it was a very suspect project. And of course, when liquidity gets reduced, it's some of the worst projects that fail first. But what happened, and I think we can learn from this, is that there was a chain reaction where a fund called 3 Arrows Capital, which had previously been very well respected, filed for bankruptcy after defaulting on a crypto loan worth over $650 million. And there we hear that word default, and that's something that we're going to hear more of. And then BlockFi took a hit of $80 million of bad debt from that loss of the crypto hedge fund 3 Arrows Capital. And that caused essentially a run on the bank on BlockFi. And again, run on the bank, that's another theme here. And BlockFi went bankrupt. And then following that, we probably all heard about FTX. They faced their own liquidity crisis, a shortfall of up to $8 billion. The assets weren't there. There was another run on that firm, and they went bankrupt. So, you might look at this and say, okay, it's a bunch of bad actors getting what they deserved. But I also mention it because it's setting up a sensitivity in Silicon Valley to defaults and bank runs. And that leads us to the next domino. So Silvergate Bank is a bank some of you may have heard of, was a fairly prominent, well-respected bank, had two major areas of exposure. One, crypto, and two, actually commercial real estate loans. So now we start to get back to our thread here about commercial real estate. And Silvergate Bank fell prey essentially to a bank run because of their exposure to the crypto world. And what happened was a tech industry that was looking at crypto and becoming skittish about bank runs caused by debt defaults started looking in their own backyard at Silicon Valley Bank. And Silicon Valley Bank was the largest lender to tech companies. So we're talking young tech startups. They raised money, they had a couple $1 million in the bank. Many times they were required, actually by their investors and by the terms of the fundraising, to put that money at Silicon Valley Bank. They didn't even have a choice. And what happened is suddenly their investors started telling them, you got to pull your money out. So what happened at Silicon Valley Bank? Well, the bank itself, they thought they were being actually fairly conservative. And they were investing in government bonds, which is what the Federal Reserve told them to do. But they got a little greedy or a little lazy, however you want to explain it, and they didn't hedge. And the issue is that when rates go up, bond prices go down. And those very safe, theoretically very safe government bonds, the prices declined, and that created a hole in their finances. Now, arguably that hole was not so big that it couldn't be filled. But here there's a technology story to it, which is that technology has made it very easy to withdraw funds online. And so what happened is when the Silicon Valley investors and the startups started to get concerned about liquidity at Silicon Valley Bank, they all pulled their money out at once, and that caused a run on the bank. And over the course of a weekend, the government had to step in. The equity holders of the bank were wiped out. but the depositors, largely companies, Silicon Valley companies, companies across the US, were protected above the FDIC limit of 250,000. And a lot of these companies really needed that protection, because if they didn't have it, they wouldn't have been able to meet payroll. And so that takes us to the next step in the crisis. And people started asking, well, what about real estate? And I see on the chat also some questions about other banks, and we'll talk about that. Definitely, there remains concerns about other banks. Even recently, First Republic had gone down a bit, and it seemed to be protected. It's a very well-run institution, but recently the stock is down again due to concerns about First Republic. So certainly people had concerns about other banks, and they started to ask about, what about real estate? And I've included here just 3 articles. They're not all negative. So, some people are saying, well, that crashes, it may never happen. So I'm not, I think we need to be balanced in our assessment of this. And, but let's dig in, I think, is the best, and then come back to say, hey, is it, what is valid about these concerns, and what is just kind of trying to get clicks by providing fear and scary news. And I think the answer is somewhere in between. So let's get into it in some more detail. So looking at real estate, inflation in commercial real estate, inflation combined with high interest rates are essentially a 1-2 punch for property owners, right? So inflation, rapid inflation, it raises your operating costs faster than you can raise your rents, because the rents, you're going to have long terms for rental contracts. Not all the leases come up at the same time, so you're going to have lagging increases in lease rates, but the operating costs are going to go up. So that's going to start to pinch the cash flow and the net operating income of the properties. Meanwhile, you have higher rates, so more interest expense, and that hurts the cash flow of the property. And that's especially true because in commercial real estate, about 1/3 of all commercial property debt is floating rate debt. And actually, 48% of the debt on office properties that matures this year is variable rate. So variable rate debt, floating rate debt, it's not the most prevalent, but it's 1/3 of the market, which is quite a bit. And the way that works, many of you probably know this already, but just to cover the basics, is that you have a rate, used to be LIBOR, now it's the secured overnight financing rate, shown here. And you add a percent to that, let's say 3%, depends on the terms, varies widely on the type, based on the type of loan. And that overnight financing rate, on which all of these floating rate loans are based, well, it was around 0, throughout 21 and early 22. But as the Fed raised rates, it's increased to here, up to 4.8, and potentially continuing to go up. So very rapid rise. And how does that play out when you look at an example of a property? Well, if you're a property owner, commercial property owner, let's say you have $100 million property here and roughly a 5 cap, right? So 5 million of net operating income. And you might have taken some money off the table. You might have a 60% debt, and you might have been paying 3% on that debt back before all these increases in interest rates. And so you would have had $4 million in interest expense, 5 million less 4 million, you have 1 million of cash flow. You're doing okay. That property is doing all right. However, if that loan goes to 7%, it's very likely in this environment, you now have 5.6 million a year in costs on 5 million of net operating income, and that means you're making a loss. In this example, 600K, a loss. So what are you going to do? You might have to have a capital call. You've got an issue. You might be able to cut costs. You might have a little bit of capital in the property offers, but you can't do that forever. So that's the issue that's happening now. And you saw that quite recently where, for example, Columbia had a property where they were subject to these floating rate loans and they went into default. So the second issue here are loans that are maturing. And I referenced this in my talk in December. And about 10 to 15% of all commercial property debt matures annually. So according to one estimate by a company called TREP, that's of the real estate loans held by banks, you've got 270 billion, that's a billion, set to mature in 2023. This is a huge number. About a third of that is in office properties. So very large amount of maturing loans coming up every year, this year included. And I want to walk through another example there. So imagine, again, this hypothetical $100 million property, but that property has a loan that needs to be refinanced because the loan's maturing. Well, they had been, let's say, at a $60 million loan with a net operating income of $6 million. This just as an example. This would be a 6 cap property. And the banks typically would demand like a 1.3 times debt service coverage ratio. So they would have been able to sustain that debt level with their net operating income. But when it comes to refinancing, now at 7%, they can no longer get the same amount of debt. So they can still bear the same interest expense, 4.7 million, right? They're still at a 1.3 debt service coverage ratio, but now they have to lower their loan amount by $10 million. And the question, of course, is where are they going to get $10 million? So they need to do a capital call, or they need to sell, or they hand the keys to the property back to the bank. So those are some very tough decisions that a lot of property owners are facing this year and potentially next year also, if rates don't go back down. And we see that is in fact what is happening right now. We talked a bit about Columbia Property Trust and the default there. 1.7 billion, a very large default. I think there's been quite a bit of press recently on Brookfield, which defaulted on a second major office portfolio this year. And there's growing concern across the market about these defaults. Now, I think it's important to be balanced here. Most of the banks, they don't want to own the assets. They don't want to own these properties. So what they're doing is they're pushing the maturities. And we're seeing that across the board where the banks are pushing the maturities and people are hoping that interest rates will come down in the next 12 to 15 months. And the issue is that, as I mentioned earlier, CMBS loans, conduit loans are more difficult. There's less flexibility for borrowers. So there's certain types of loans where the maturities are not able to be pushed and they need to refinance. And that's where we're getting these issues. And for property owners, what they're looking to do and they're managing is to say, hey, how can I deploy my capital with, and save my best assets, right? So they're going to let the worst performing assets go. And some of those assets that they're letting go may actually be underwater already. It's possible that they've already taken a lot of capital out and they just prefer to give the keys to the bank. And in fact, if you are a REIT or a Brookfield of the world, you have a fiduciary duty to your limited partners to profit maximize. So in that case, if the property is underwater and you have the opportunity to give it back to the bank, that may be your best, most profitable option. And so you have to do it. But this is certainly risky. The question is, how long can this goes on? On the one hand, these banks that are getting the loans, they're potentially underwater loans, they're already under pressure. We talked about First Republic, and there are quite a few others. So if they now are getting losses on their loan portfolio, that could be concerning. Second, what if these banks get the properties and then need to sell them quickly, and they sell them for cheap, and that impacts overall pricing in the market? That could be a concern. It could lead to a vicious cycle. And then, finally, how long can these banks push the maturities? That's a game that can happen for a certain amount of time, 12 months, 18 months, but there becomes some time where if rates don't come down, that can no longer happen. And then you could have a wall of even more properties that need to refinance coming maybe in 8, 12, 14 months from now. So, that's the concerns that are in the market. And, well, we go back to the Fed. So here's Powell. And what did he say? March 22nd, 2023, he said, we're well aware of the concentrations people have in commercial real estate. He's talking about the banks here. I really don't think it's comparable to this. The banking system is strong, it's sound, it's resilient, it's well capitalized. Well, you can judge for yourself what you think of this. I think many people in the markets are concerned that the Fed missed it before and they may miss it again. But there's some balance to that. If we look at the REIT index, the S&P United States REIT index, it had dropped quite a lot, about 11% after Silicon Valley Bank failed, but it's recovered most of its losses. And I would guess, that's largely because REITs have more fixed rate loans and fewer floating rate loans. On the other hand, the KBW Regional Banking Index is down 14%. And so even though deposit loss in the banks has slowed a lot, it's really just a trickle, still there's continuing concern about the banks. And finally, you actually see digital assets like Bitcoin are back up. Bitcoin recently trading up to $27,000 from lows of 18 or 19K. So I think that you've got a situation where the banks and the Fed are closely aligned to prevent a vicious cycle where distressed sales of commercial property spark a fall in prices, and that gets worse and worse. So you've got a big alignment between the banks and the government, and I do think my prediction is that you will see the government stepping in at some point here. The market though is very complex in commercial real estate. There are different segments. So If you look at warehouse and industrial space nationally, vacancies are low. Um, if you look at multifamily, vacancies are around 5.8%. So vacancies are also low, although there is some concern in multifamily about prices not rising fast enough. Um, Retail vacancy rates, surprisingly, are actually only 5.7%. So in spite of the migration of shoppers to online, we're seeing surprising strength. And actually, hotels are seeing a lot of people want to travel post COVID, and prices are surging, and the hotels can charge those prices, so they're actually getting a record revenue. So I think there are going to be certain sectors where this is going to be an issue in terms of financial distress, and others that are going to be okay. Um, and now I want to turn, in kind of the last minutes that we have, about 10 minutes more, to opportunities. Um, and also, if folks have questions, please feel free to pop those in the chat, and I'll try to address them as I wrap up. Um, so I think it's important for me to give you some thoughts, not just threats here, but hey, what are the opportunities in this crisis? There's an expression: never let a good crisis go to waste. And so let me throw three things out there. First of all, invest in understanding debt restructuring and refinancing. And obviously, the more relationships you have with lenders, the better. If you're working, on sales. And one thing that you may not have thought about is lease assignments. I'm sorry, mortgage assignments. So mortgage assignments is a way for the mortgage lender to transfer their interest in the mortgage to another party. So imagine you have a loan, a property with decent terms and long maturity. Well, if they're looking to sell that property, they could actually sell the property and transfer that loan to the buyer. So that's a complex process that you can hire people to help you with it. It needs bank approval, of course, but deals like that are being done. I know of deals like that being done, and it creates a tremendous amount of value for the parties involved. So that's an area where there's opportunity. A second area of opportunity is for distressed asset acquisition. I think everyone understands that broadly, but I hope that I've given you here some tools to understand, what are the ways to find the best targets. So, for example, properties with loans that are maturing are going to be a great target for distressed asset acquisition. And you can actually get that data. A lot of the data is public, depends on the geography you're in. A lot of people like CoStar have it. And so you can get the information on properties with maturing loans. You can crunch the numbers to see what the loan terms look like and target properties that are going to be facing a crunch. And that it can be helpful whether you want to reach out to those property owners, and say, hey, let me help you sell, because they may need to sell. Or on the other hand, if you're representing a buyer, that's a value add you can provide to the buyers to help them find assets that may not be obvious out there. So that's a second opportunity in this time of challenge. And then a third is working with bank-owned properties. So, banks are going to need to sell properties. They're going to need to, lease properties they own. Obviously, this is challenging. Getting relationships with the banks, dealing with all the bureaucracy can be hard. But I think that it's, if you can do it, very valuable. And, a big challenge here is, managing the different web of relationships and really understanding, hey, what does the bank do? Who's the asset manager? Who's the property manager? What are the different relationships there? I think that that is also an opportunity that you guys may want to uh, take a look at. And with that, I want to mention a kind of a, fun opportunity here. Um, so Snap Instruct is one of my companies. It does corporate and compliance training over text message. And we're opening up for you guys access to our new beta AI instructor, and are offering 3 courses on these opportunities here. So how to address these, how to get, gain expertise in these opportunities. And what's cool is that you can do that over text message, and you go deeper at your own pace in little bite-sized lessons. So if that's something that you're interested in, text 888-758-1983, and I'll put that in the chat. And you will get connected to an AI coach that will help you learn those things. Also, feel free to reach out to me if you've got feedback or comments, and I'll put that also in the chat right now. And with that, I'm going to reach the end here. And if anyone has comments, I'd be happy to address them or questions. And thank you so much. It's been a real pleasure.
Thank you, Olivier. That was excellent information and the opportunities. I mean, and that's pretty cool. That Snap Instruct, AI is the way to go, right? It seems to be the big thing right now.
Yeah,
So,
yeah. I think
thing.
next time I'll be in front of you, I'll be talking about AI. There's a lot going on there. Very interesting times. I think big impact on on everyone's business.
Absolutely. That's, it just seems to be the way to go here. Well, I appreciate your time, and everybody take the information down here, reach out to Olivier if you have any questions, and, plug into his Snap Instruct and get educated on it. I appreciate it, Olivier.
Awesome. Thanks very much, everyone. It's been a real pleasure.
All right. Thank you.